Jane has reached preservation age and recently retired. She has a superannuation fund with two accounts, one being in accumulation phase and the other being in income stream phase. The assets for each account are separated, and so administration expenses and investment fees are easily identifiable for each. The accumulation account earns income from franked dividends, interest and capital gains. These are taxed at concessional rates inside the fund. The income stream earns income from interest only. This is considered exempt income and is not taxable. The fund's taxable income and net tax payable can be calculated accordingly. Taxed superannuation funds treat concessional contributions as assessable income, and so they are taxed upon entry to the fund. However, non-concessional contributions are not subject to taxation. Once inside the superannuation fund, there are a range of taxation consequences that depend on the phase the fund is in, the types of earnings generated, the expenses incurred, and the classification of transactions. While complying funds enjoy concessional tax treatment, earnings in non-complying funds are taxed at the top tax rate. Superannuation funds are generally either in the accumulation phase or the income stream phase. It is also possible for superannuation funds to have multiple accounts, with part being in accumulation phase and part being in income stream phase. Funds can remain in accumulation phase while the member is working and even post-retirement. Funds in this phase can receive deposits, and their earnings are subject to tax. Funds can only be in the income stream phase once the member satisfies the conditions of release, such as retiring or reaching preservation age. While they can no longer receive deposits, and while there is also a balance cap, funds in the income stream phase generate tax-free earnings. Superannuation funds generally invest in equities, money market securities, property, bonds and other assets. These generate earnings in the form of interest, dividends, rent and capital gains, each contributing to the assessable income of the fund. Franked dividends need to have the franking credit added to the assessable income, with an offset available for the tax already paid. Capital gains may also be eligible for the capital gains tax discount. Earnings for funds in the accumulation phase are taxed. However, earnings from assets supporting the income stream are tax-free and therefore exempt. To calculate the taxable income for the fund, deductions can be subtracted from assessable income. Operating expenses reflect administration costs and professional service fees and are generally deductible. Outgoings of a capital nature, such as the purchase of depreciating assets and building works, are not deductible immediately and are subject to the capital allowance regime. Insurance premiums for certain types of coverage are also able to be deducted by the superannuation fund. However, expenses relating to exempt income in the fund are not deductible. If the assets and expenses of the superannuation fund are not separated between the accumulation phase account and the income stream account, then an apportionment of the expenses is required to determine deductibility. Some transactions and earnings in the superannuation fund may be deemed non-arm's length. That is, the super fund has transacted with a related party or otherwise at terms that do not reflect market conditions. In such situations, deductions are still available for such non-arm's length earnings, and the net earnings are subject to the top tax rate. To recap, taxation within the superannuation fund depends on a range of factors, including the phase the fund is in, the types of earnings generated, the expenses incurred, and the classification of transactions. Complying taxed funds are subject to concessional taxation on earnings. However, earnings in non-complying funds are subject to the top tax rate.